The broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody. Thank you for joining us for this webinar, Prospects for Growth and Change, U.S. Metropolitan Areas. My name is Brian Reel, Marketing and Event Coordinator at REMI, and I'll be hosting this webinar. The two presenters for this webinar are Frederick Treyz, Chief Economist and CEO at REMI, and Jerry Hayes, Senior Vice President of Research and Development at REMI. At any time during this presentation, we encourage you to drop any question you have into the question box. At the end of the presentation, time permitting, I will moderate these questions to Fred and Jerry. Shortly after the conclusion of this presentation, a link containing a copy of the slides and a recording from this presentation will be emailed to you for your reference. If you have any questions about these materials, I encourage you to reach out to info@remi.com and we'll make sure to connect you with somebody to assist you. Thank you again for joining us, and take it away, Fred.
Thanks so much, Brian. And thank you for joining us today, for those who are online. And I'm going to be talking about prospects for growth and change, U.S. metro area forecasts from 2022 to 2032. And this is based on a paper I have in Economic Development Quarterly, which more fully describes our methodology and some of the conclusions. So I want to be talking about the national economic context in terms of developing these REMI forecasts, which I'll present, regional demographics and economics. I also want to stress how economic modeling is a framework for analysis, and then some of the policy challenges that we're looking at in the context of what we see as the prospects for the U.S. and regional economies in the next 10 years. So I want to start with kind of a wordy introduction because I want to stress here that what I'll be showing is the REMI Regional Economic Models Inc. or the REMI baseline economic forecast for the top 20 metro areas, but to stress that REMI is an economic forecasting and policy analysis model. It's a model which then can be adjusted and adapted by users to reflect particular expertise around their area. So our baseline forecasts are developed with a transparent methodology. The assumptions are very clear. Our structural, economic, and demographic equations are available in published form on our website, so you can see exactly what's going into the model, as well as national macroeconomic forecasts, which we base primarily on projections from the U.S. Bureau of Economic Analysis and the Congressional Budget Office. So we want to have a forecast which is really our growth projection based on being very clear about the methodology and assumptions that we have in place. Now, this forecast we feel is quite solid as it is as a default forecast, but we've had extensive experience working with our clients where the model users have local expertise or local or regional information about their economy, which can be used to enhance and obtain a more accurate forecast. For example, planned economic developments. There have been some major announcements. For example, Micron having a large semiconductor plant announced recently to be built in upstate New York. So that a model user can then put in the employment schedule for that particular region of New York State and get a much more accurate forecast because it includes a new economic driver, which, based on our, standard methodology, wouldn't be known to us. You can also look at potential scenarios. For example, a what if for a recession that may or may not occur, or the effect of policy changes. For example, like a major revision of the tax code. So these default forecasts need to be taken into the context about here's the forecast, here's the methodology, but we've been very open to better understanding what's going on in the ground level for various metropolitan economies. So we start here with the national economic context, and I'm calling REMI a top-down, bottom-up methodology, where a top-down, sort of a pure top-down methodology would take a national forecast and then to regionalize it, one would just share out the national forecast to the region. So if GDP goes up by 2% at the national level, that would be applied across all regions, or even maybe with some industry detail that would be applied off on that. A bottom-up methodology for state or regional economies and the national economy would be to look at the dynamics of what's happening within a state and then add up all states to get the national total. So we have both in play. We have a national forecast that we develop, which drives the regional forecasts, but REMI also incorporates a vast amount of region-specific information, in particular, the demographics of a region, which are critical to understanding its future growth, the industry structure of a region, and so that there may be high growth and lower growth industries, supply chain linkages, trade linkages, prices, and a very comprehensive data about what's happening at the state or metropolitan level. To develop the national forecast, we use from BLS IO tables, which are projected to 2031, employment by industry projection to 2031, and labor force participation rates through 2031. We take this forecast to give us a 10-year forecast, and we initially developed this in 2022. We take it out to 2032, so we have REMI projections beyond this 2031 time period. In fact, out to 2080 in our full model. But a lot of what's being seen in these metropolitan forecasts is basically driven or dependent on these employment by industry projections, labor force participation rates, and other input-output information coming from BLS. We get fertility rates, survival rates, international migration from census. We also use for the short term, so that would be in the first couple years of the forecast, data on GDP, personal income, and employment from RSQE, which is the National Economic Forecast out of the research seminar in quantitative economics at the University of Michigan. So we use that as an input to our national forecast. And then the long-term forecast, national forecast in REMI is based on the Congressional Budget Office National Economic Forecast. So in summary, we can see just at the most aggregate variables for employment, population, labor force, and GDP from 2022 to 2032, an increase in employment of about 3%, population about 5%, labor force about 6%, and GDP in real dollars of about 18%. So in contrast to previous decade-long periods in the US, employment growth is fairly slow, 3% over a 10-year time period. We see labor force, which is being driven by the demographics, grows a little bit faster than employment. Now, this could imply that the productivity growth that we project is actually a little bit too fast, and that employment and labor force growth are going to track each other equally. There also may be some increases in the unemployment rate, and they're coming from different directions. Employment is more driven by final demand and the BLS long-term projections, whereas the labor force is driven more by the demographic factors. And then GDP goes up about 18%, which is roughly in line with a 1%, 1.8 or a little bit less increase in productivity on an annual basis, and that to a large extent is consistent with Congressional Budget Office. So then if we look by industry, I think it's helpful to focus on the difference in employment from 2022 to 2032 and focus particularly on what are the big job gainers and what are the big job losses. So what really stands out for job declines, again, this is driven largely by the BLS assumption, is a 1.8 million drop in retail trade, part of the ongoing consolidation, big box stores. We've now seen a lot of self-checkout being introduced. So employment in the retail sector continues to be under pressure for the next 10 years. Healthcare is the biggest gainer, with over 2 million job increase, about a 10% increase. State and local government, professional scientific and technical services also seeing gains. Interestingly, the information sector, which actually is relatively small employment sector, 3 million compared to 23 million, and healthcare services is actually showing a decline, sort of with the adoption of technology and artificial intelligence. So that's not growing at a particularly high rate. And then for all industries, there's about a $7 million person increase in employment over this time period. Now I want to jump into the regional part. So again, we're talking about a top-down, bottom-up modeling methodology, where that national forecast and then the employment forecast is an essential part of understanding what's happening at the regional or the metropolitan level. For example, if your region is a county that has a large concentration of hospitals and medical care, then with that industry structure, when we see healthcare growing a lot over the next 10 years, that will translate into increased employment in that industry and in the locality. Of course, it may be offset by various competitiveness factors. So for regional demographics and economics, is some of the core issues in demographics are the age structure of the population. So if a population age structure of a region is relatively younger, then that region will have a larger labor force with larger labor force participation rates, especially the 25 to 55 category, and then that age structure will persist. So we know a lot about the future course of a regional economy if we look at the age structure of a population. If a county or a region has a large population that's in their 50s or their 60s, over time the labor force will drop as those people hit retirement age. So we can project a lot about a regional economy by understanding the future path of its labor force. A second factor in demographics is amenities or quality of life. So it's a factor that seems very subjective. Quality of life, amenities. I mean, wherever one lives, you can find nice, attractive things. However, there is an economic component to this because we can measure an imputed quality of life by looking at labor force attraction in migration at a specific wage for each region. So an area that continues to attract in-migrants with a wage rate that's lower than the US average, we can infer that that region has a high quality of life. And this has been particularly important sort of in the COVID era or post-COVID era, where with the emergence of remote work, the connection between the physical workplace and the place of residence has become loosened, and we've seen a lot of movement towards regions with high amenities, such as the Mountain West, which has attracted a lot of migrants for the quality of life, outdoor living, and all the benefits of that part of the country. Another factor which is really important is international migration, which we keep at relatively steady levels of about a million per year. Again, consistent with CBO, consistent with the recent historical pattern, with the exception of a big drop-off during COVID. And the cost of living is critical for demographics as well. People are attracted to an area with low cost of living. Low cost of living means for the same nominal wage rate, you have a higher real wage rate, which especially in this time of inflation is a real benefit of locating in a particular area. With employment, I think the positive factors we're looking for is industries that are growing. So industries such as healthcare, professional, scientific, technical services, and also productivity for the industries. So a highly productive industry will need higher compensation, higher output per worker, and also strong industry clusters. So this concentration of industries like the government and related sector in the Washington, D.C. metro area are a fundamental factor in having employment growth. So here's our first chart showing our default forecast. We're listing the cities here, the US total on the top, and then the top 20 metro areas, and then the rest of the US on the bottom. So the population growth for the US, we estimate at 5.2%. So it's about 0.5% over a year, which is then higher than this remaining rest of the U.S. And the cities and the metropolitan areas are ranked by the largest metro area in the country, the New York area, second largest LA, Chicago, and so forth, down to Baltimore region, which is number 20. So the first thing that jumps out here is that the largest cities in the country, New York, LA, and Chicagoland, are seeing some of the slowest population growth in the country. Essentially, they're very large. As a city becomes large, that's associated with high cost of living and high congestion costs and limited land for new development or the addition of new housing. So those largest, especially concentrated metro areas, slow population growth. Dallas, which is number 4, and Houston as number 5. Then see large population growth, partly because they're not as constrained, as land constrained as the coastal in Chicago is constrained by the lake, and also zoning regulations for the largest 3 cities. So we see Dallas, for example, which is also a very, very large city, but much more favorable for new residential construction, keeping down the cost of living, both in terms of geography with a lot of flat, open, developable land, no major ocean or lake as a land barrier, and then fairly flexible development regulations, which allow for a lot of new construction. Also, just not to go through every city here, but we see some of the cities with that are thought of as very high quality of life, very attractive places to live, will continue to attract population. We include here Miami, which is about halfway down the list, 13.5% growth. Phoenix at 15%. Tampa and Denver also experiencing fairly high growth. Most of these large metro areas are performing at almost double the U.S. Growth in population for many of these areas. Now I'll jump over to the employment forecast. And again, we see along with the large population growth comes large employment growth. More population means more demand for services, for government services, for retail and related services, for housing. So along with high population growth, we see Miami, Phoenix, and Tampa experiencing higher employment growth. Again, the largest cities in the country, and this would include also then Dallas and Houston, see relatively low employment growth. In fact, all those top five metro areas with lower employment growth than the U.S. total. And I also want to point out here that I guess, surprisingly to me, is that out of our default forecast, we see Houston coming in at an employment loss. So we track down what is the explanation for this. And it's largely driven by the BEA the BLS long-term forecast of employment growth in oil and gas and some associated manufacturing industries, which they see as losing employment over the next 10 years. I'd suggest again that the default forecast and our methodology may underestimate the potential for residential development in Houston with negligible or zoning regulations and a pro-development environment. Houston and Dallas may be able to have much more residential development, population growth, and employment growth than might be suggested from our methodology. But we wanted to sort of present it with a transparent approach here, what's driven by the REMI model equations, the demographic structure of a region, and also these national projections. We can see too areas with strong industry clusters have fairly high employment growth, and Washington, D.C., and that government and related sector jumps out here in particular at a 5% increase in employment, and other cities such as Boston, San Francisco, Seattle, San Diego, Denver, also with these strong industry clusters, have employment growth which is faster than the U.S. total, U.S. total being 3.4%. Then we can turn to real disposable income per capita. So we've seen a lot of differences in terms of population growth and employment growth for the different metropolitan areas. When we look at the growth in real disposable income per person, it's much more level from one region to the other. So, for example, Detroit, which is down towards about six up from the bottom, that Detroit showed fairly low employment growth, low population growth, but real disposable income growth is very high, 20% compared to 17.5% US average. New York, LA, and Chicago, which we also saw were weak on employment growth, weak on population growth, are quite strong in terms of real disposable income per capita. So that we can look at the lens of metropolitan economies, and we often think, almost like from political terms, is a good city is a city that's growing in employment and growing in population, and that's a measure of a vibrant city. And I think one would say that certainly is a very valid measurement of the vibrancy of a city. But for an individual living within a city, we do have a mobile country and a free country where individuals on a daily basis are making choices about where to live. So this means that a city, even if it's losing population, would need to maintain wage rates at a level to make it attractive for those who stay to stay. So we see that income growth is pretty strong in New York, LA, Chicago, and Detroit, Baltimore, and other cities that may be losing population. Some of the fastest growing cities in terms of population have slower increases in real disposable income per capita. As the new population enters, you have an increase in the labor supply, and that tends to push down wages. So what jumps out here is Dallas, with large population growth, has relatively slow growth in terms of real disposable income per capita. Denver, similar. Seattle and Phoenix and Atlanta will all see increase in income per capita slower than the U.S. So there's this balance here. Cities may be growing in population, not so much in real disposable income. A city that's slow growth in terms of population may actually, for the individual, do fairly well in terms of growth and real disposable income. Now I want to put these together on a matrix, and I'm going to just take a minute to explain what this shows. The y-axis, so this is up and down, shows the difference in the region for GDP percentage growth. The x-axis shows the difference from the national average population growth. So the intersection of the x and y axis, sort of that zero intersection point, is the U.S. average. So this shows the difference in the U.S. average, and the rest of the U.S. outside of these metro areas is a little bit slower in population growth, a little bit faster in GDP growth. So we can look at these quadrants. Let's say the upper right quadrant we can see as the growth cities. So these have higher than average GDP growth and higher than average population growth. So we see these quality of life cities, Phoenix, Tampa, and Miami, attract a lot of high population growth, and along with that, as well as the industry growth, there's high GDP growth. Seattle, San Francisco, metropolitan area, Denver, Dallas are also in this category. On the lower left quadrant, we see that these have slower than average GDP growth, slower than average population growth. So we could generally typify those cities as the largest and also very mature cities: New York, Chicago, Los Angeles, and Philadelphia. Detroit's slow on population growth, high on national GDP growth. There's a lot of manufacturing in that region. There's an aging demographic, so the population growth is relatively weak, but the manufacturing industries continue to experience GDP growth, so it's a little bit higher than the U.S. average. And then we have Houston, Minneapolis, Baltimore, Washington, which are a little stronger on population growth, but less on GDP. Now we can just look at employment versus population growth. So instead of output, it's employment. And we see now Washington with somewhat relatively slow growth in employment, then has in GDP, now has jumped up to the upper right-hand quadrant in terms of employment. So employment's growing faster. That means more employees, relative to the GDP. So somewhat slower productivity growth, but strong employment growth. And we see again, Miami, Phoenix, Tampa, Seattle, Denver, Washington, San Francisco, Boston are then in this growth category. And the New York, Chicago, Detroit are slower population, slower employment. Houston, Minneapolis here come with slower employment growth, this is partly what comes out of these industry projections from BLS. Next, I just want to talk about economic modeling as a framework. So the forecast, this information are the default projections we have based on the REMI model structure, the equations and how the different parts of the economy interact. It has to do with the base demographics of a region, and it also has to do with the national forecast projections coming from BLS and the Congressional Budget Office. But as a framework, the REMI has this capacity to make changes in the national forecast. So those changes could include gross domestic changes in productivity. Basically, from Congressional Budget Office is that logs in at about 1.8% per year, which is consistent with the long-term growth in productivity. Last year, 2022, was terrible for productivity, with productivity declines. And that 1.8% is largely an assumption based on the long-term growth in productivity. But economists really don't have a completely firm understanding about what's driving that productivity increase. So productivity growth could be faster than that 1.8%, or it could be slower. Another set of assumptions in the national forecast concerns demographics. So this would be immigration, which is kind of flat at about a million per year, and CBO is forecasting it out that way, but it has the potential to go down if we have stricter border security and immigration laws, or it has the potential to expand if immigration policy becomes more open to immigration. Birth rates are also an unknown. They've been dropping and have continued to drop, especially during COVID. And we have the current birth rates, so that gives us a good understanding of what the population will be right now. If somebody who's just born this year, we know how old they're going to be in 20 years and know how old they're going to be in 30 years, but whether those birth rates recover to a higher level or continue to go down or stabilize where they are is somewhat of an unknown. We also have labor force participation rates built into the national forecast. And I think the particular question mark with labor force participation is the over 65 category. And that labor force participation could stay pretty high or go up, as many people are quite capable of working past the traditional retirement age, or it could go down. And again, we use the assumptions in labor force participation rates that come from census. On the regional level, some of the assumptions which might be scrutinized would be housing price and land use constraints. So it could be that some of the coastal cities are more constrained than have been estimated with a model, and that some cities, in particular southern cities, especially in Texas and Florida, may have much more potential for residential development than is given in these forecasts. Factors having to do with amenities and quality of life, which seem to be quite important in attracting labor force and attracting migrants. Something we have not maybe haven't fully accounted for in REMI is the urban hierarchy of cities, where you have clusters, you have LA. We saw some of those largest cities have a decline in population, but New York is still the primary city in the US. LA would be the next largest. Chicago would be the next largest. A city like Atlanta holds a unique place in the urban hierarchy because it's the quote unquote capital of the Southeast. And just by that position as being this capital of the Southeast tends to draw in talent and people and businesses and location from across the entire region, which may push its economic development in a way that hasn't fully been captured in our metropolitan forecast. And then a final, I think there are more that we could look at, but another area of interest would be the future of work. What does it mean with artificial intelligence? Does it mean that there's going to be losses in professional service jobs? What is the emergence of remote work? What does that mean to the economy, and especially the regional economy? And then I'll just jump into this graph, which I think illustrates some development patterns from 2020 to 2022, really during this pandemic period, and that certainly we've heard of anecdotally, people moving into regions that are more rural, that have amenity attractiveness, and also have a lower cost of living. So we have the Mountain West with outdoor activities, scenery, mountains, and the attraction of that region. Some of the rural areas in New England, Maine, almost surprisingly, the northern Michigan, some of the rural parts of the upper Midwest and the South, coastal regions, which are in the Southeast in particular, which are very desirable. Florida, with its pleasant climate, low cost of living, and low taxes, and Texas, especially the outer suburban counties of Texas, also experiencing some of the highest levels of growth and the change in population from 2020 to 2022. And I think there are a lot of different factors in play here, but I guess one of the core things we see is, what does remote work do? What is the loosening of the connection between place of work and place of residence mean? And I think that can really be illustrated here in which parts of the countries have grown, which is basically some of the lower cost of living and highly attractive parts of the U.S. A further factor we have here is policy challenges that really can change, policies can change the economic development trajectory of a region. Atlanta made the decision to expand the airport in that city many years ago, and it's really since emerged over the last 50, 60 years as the capital of the Southeast, creating a lot of economic growth. Denver as well, with an airport and other factors, is now becoming a leading city and a growth pole. Some of the economic development policies, in particular, the availability of new residential construction, have been very important for economic growth in cities, particularly Texas and Florida. So the kind of policy challenges we face are, first, there's the overall context of US demographics, where at a national level, the population is aging and the population growth is slowing, so that we have not a lot of population growth, not a lot of labor force growth into the future. So cities that want to grow population need to almost bring population in from other areas. There are also major US macroeconomic concerns, and I'm just pulling one of these factors out. The US debt, now it's a little bit reduced, but got as high as 120% of GDP. So they're big financial fiscal problems ahead of us. That's at the national level, and certainly the states face those issues as well. We also have a context of looking at policies and politics as a zero-sum game. So there are political challenges involved in establishing policies where you have a win-win policy that reforms some areas in our economy in such a way that promotes economic growth. If we begin to see the world as something where one group can't be made better off unless from taking from another group or another part of the country. And then government spending is, well, I'll also just step back and say we have this bottom line assumption of economic growth at 1.8% in terms of productivity growth. So a question is, how do we don't quite know where that comes from. We have incremental improvements in many different areas, in technology and healthcare, in retail, and from all those incremental changes, we've seen productivity long-term increase at a 1.8% annual growth rate. I'd also suggest is that productivity growth in the US depends a lot on government spending, which is about 30% of GDP if we take state, local, and federal government spending. And a lot of government spending is focused on long-term productivity improvements. For example, education, the purpose of which is to exist as a society, but also to train and educate a future labor force which will be able to contribute to the economy. infrastructure spending on roads and water and airports and broadband and other types of government spending are, again, investments in the future, where that infrastructure investment is a key component of U.S. productivity. So the policy challenge is to make sure that those government resources are being spent widely, because taxpayers are paying for it and expect some value out of that government spending, but also the effective use of government resources is integral to being able to expand productivity in the U.S. into the future. And then just to jump back to this demographics, to look at the major U.S. challenge here, and there are many challenges, but since we're focused here on an economic demographic model, we can look at this aging of America and slowdown in population growth. So the line here shows the working age population for the U.S. is from 2022, this goes out as far as 2040, is very, very slow growth in the labor force for the U.S. And then most of the population growth in the U.S. out to 2040 is in the over 65 category. So it increases the dependency ratio, and then age 0 to 15 is basically flat or declining. Now, what this means is we have this U.S. context of an aging population, very slow population growth, most of that population growth being in the over 65 age category. So now that means for every city that's gaining population and expanding in population, essentially some other region of the country will be losing population. And we can see that here for New York, where the working age population declines out to 2040, the over 65 increases fairly quickly, and then the 0 to 15 is also in decline. So this is one of the challenges that will be facing many of these regions. And then that's the US, and this is New York. So thank you very much, and I'd love to take some questions.
Great. Yep. Thank you everybody for attending, and thank you for the great presentation, Fred. A copy of the slides from this presentation and a copy of the recording will be made available shortly to your emails in about an hour. If you have any questions from these materials once you receive them, I encourage you to reach out to info@remi.com, and we will connect you with the right person to assist you. So now we'll get into some of the questions we received. We received more questions than we'll be able to answer right now. So if we don't get to yours, we will make sure to reach out to you following this webinar.
Right.
So the first question was, utilities are losing 10% in employment. How is this possible when the trillions thrown toward decarbonization and climate mitigation, from electric cars to renewables?
Well, this goes back to the BLS long-term projections. So they would be the experts on where that comes from. Utility employment tends to be very, very high output per worker. So it tends to be very capital intensive and not very labor intensive. So many of those investments and changes may be a large increase in the output without necessarily a corresponding change in employment. And we've seen manufacturing in general and and utilities may fit into the same category, that some of those very engineering focused type of industries is that there are opportunities to increase productivity. So those engineering capital intensive industries often can see ongoing productivity increases, especially when you compare that relative to social services, caring industries, in which that human element is very important to the delivery of those services, and tend not to see big productivity increases.
Excellent, thank you. So the next question is a bit of a long one, but I will start now. So I see.
Yeah, and if I may interject, Brian, is why don't we take this to 3 o'clock, and then those we can just sort of end. But then if some want to stay around for another 5 or 10 minutes to get through further questions, to invite folks to do that.
Sure. Yeah. Then we'll get into this one as well then. So feel free to stick around, everybody, past 3 if you are interested in some of the upcoming questions. So next is, I see in recent BEA and BLS data that the 2020 pandemic business closures disruption and subsequent 2021 to 2022 macroeconomic difficulties like supply pipelines and inflation have shuffled and reordered the performance of metro economies around the country. I expect reordered comparative advantages and disadvantages of metros around the country. Have you considered what variables beyond industry mix have changed most and with the most leverage on specific metros' employment and GDP time series?
So the question is, what metrics have changed the most?
Yeah, besides industry mix.
Certainly, commuting patterns have changed a lot. There is a residence adjustment, which is place of work versus place of residence. For professional services, the typical experience would now be not necessarily completely abandoning, let's say, the center city as the place of work, but maybe that would only be 3 days a week or 1 day a month. So I think one of the big shifts has been the work from home, and along with that means there's much less spending occurring in the central city, because a lot of the spending on retail and other activities was tied to commuters coming from outside of the city. So I would say that's one of the biggest shakeups, and there may also be some reverberations with that in terms of government finances. So less capacity for the center cities to raise taxes, and we're beginning to see some signs of fiscal stress with commercial real estate and other areas.
Excellent, great. So then the next question that I'll ask kind of has to do a little bit with remote work, which you mentioned. So it is, do you suppose remote work may cause people living outside of metropolitan areas, thus causing the rural areas to gain population? Or do you suppose people will stay within metropolitan areas, although perhaps much further from the centers, while working partially remote? Which trend have you used in your calculation?
Well, what we're seeing from that latest map from 20 to 2022 is many rural areas, and I would say like quote unquote high amenity rural areas. So the Mountain West, we even saw some growth in Maine, in northern Maine, and some of the rural counties in the South, and then Florida, Texas have gaining a lot of workers. So there's that changing region trend we've seen, and that's fairly apparent. And then also suburbanization within metro areas. So suburbanization of New York out to Long Island, and New Jersey. The metro areas are very powerful economic magnets, and it's that having access to the core for specific business meetings, to be able to meet in person from time to time, is very important. The metro areas also have amenities in terms of sports teams, schools, housing, and other amenities of those areas. So I don't see a widespread migration to rural areas, just a little faster growth in some of the high amenity or rural areas that we've seen, a shift to the Sun Belt and lower tax states, Florida, Texas, and then also more suburbanization. So the answer, I suppose, is all of the above.
Excellent, thank you. Next, we have another question. It's a bit longer. It seems to me that the greatest difficulties in 2032 metro employment forecast would be A, knowing what is the labor force participation ceiling for a metro, and B, how close to that ceiling are we in the first year, 2022? And has the metro done, and what has the metro done with its rebound from the 2020 recession? The first thing is difficult to project. The second thing varies among metros extremely. One example, Minneapolis, St. Paul is still rebounding. Remy expects 1.7% growth during 10 years. Minneapolis, St. Paul has already surpassed that, growing 10% during the first year of the projection, source BLS CES.
Well, core working age labor force participation from 25 to 55 is now back to pre-pandemic levels. So some of the decline in overall labor force participation is really early retirement, and there continues to be pressure in labor force participation from retirements, not a change in the rate, just because there are more people hitting retirement age. There's been a pretty quick rebound in employment in Minneapolis and other areas. Now, the question is, can we continue to have that increase in employment over the next 10 years? And I think essentially labor force participation rates are going back up, but fairly slightly, not incredibly strong increases in labor force participation rates, despite a very low unemployment economy. And then since unemployment's so low, there really isn't a huge amount of potential without increased labor force participation for a rebound, for much more of an increase in employment in absence of a huge rebound in labor force participation rates. So I think we're fairly on track to the next 10 years does not offer a huge opportunity for very large employment increases.
Excellent, thank you. Okay, it looks like for now that is all the questions that we've received. So thank you for everybody who asked a question, and thank you everybody who stuck around. Again, thank you, Fred, for the great presentation. If you have any more questions, I encourage you to reach out to info@remi.com, and we will direct you to the right person. And like I said earlier, you will shortly be receiving a copy of the slides and a recording of this webinar for your reference. So if you have any questions that arise from that, again, please reach out to our email. And thank you, everybody, and we hope you have a great day.
Okay, thanks so much.